This is our fourth webinar in the series, How to Design a Fundamentals-Based Strategy That Really Works. And this webinar is going to be covering the principles of backtesting. I will be sticking I'll be sticking exclusively to the PowerPoint today. I won't be actually showing you Portfolio 1, 2, 3 tools because it's really more of a discussion about how to backtest than applying very specific things. But I want to remind everyone that if you have any questions at all, please feel free to interrupt by using the chat box. I'm happy to read chats while I'm presenting. All right, let's get started. The main idea behind backtesting is this. We always say that past performance is no guarantee of future results, or even worse, past performance is not indicative of future results. These are kind of things that that we're required to say by the government, and this implies that there's no relationship at all between past performance and future results. And if this were true, backtesting would be a complete waste of time. The whole idea behind backtesting is that there is a relationship between past performance and future results. And that relationship can be divided into two categories: laws and theories. If you throw a ball into the air 100 times and it always falls back down, you can assume there's an immutable law that balls thrown into the air come back down, and you can safely bet on future ball throws. Why? Because of the law of gravity. Similarly, there are absolutely reliable laws that govern portfolio performance. And these are laws derived from statistics and mathematics. And then there are theories. There are hundreds or maybe thousands of theories, and they're not nearly as reliable as laws. Now, I've come up with 4 laws of portfolio performance. There may be a lot more. I just don't know. I mean, this is not a complete list, but the ones I'm going to talk about now are diversification, regression to the mean, outliers, and alpha and beta. The standard deviation of a portfolio's returns is more likely to decrease than to increase as more imperfectly correlated assets are added to it. That is the law of diversification. And this law can be derived from the law of large numbers, which is a very important statistical law. In plain English, the greater the number of stocks you hold, the less fluctuation you'll see in your returns. I had a question in chat. Will you be available for questions after the series is behind us and I try to implement what you've described? I certainly will. You can always email me at yuval@portfolio123.com. That's the easiest way to get in touch with me. Regression to the mean. As long as there is a meaningful average of values, an extreme value will be more likely to become less extreme over time than to continue to be extreme. For example, if a particular industry has outperformed or underperformed other industries, it will be more likely to have average performance in the future than to continue to outperform or underperform. The same is true for factors and for price returns and many other things. There are other laws or tendencies that can overrule regression to the mean, as one sees with stock momentum over a 6 to 12 month period. That factor is so strong that it often overrules regression. But the law still pertains. And this explains why, for example, companies with very low free cash flow yields are more likely to have higher free cash flow yields in the future, and vice versa. Outliers. The impact of extremely large and extremely small numbers upon results is likely to make them harder to replicate. And this law applies to averages, standard deviations, compounding, and regressions. For example, the average of 2, 3, 4, 5, 6, 7, 8, and 100 is close to 17, which is not at all representative of the sample. Similarly, a strategy that has a high CAGR due to one or two outperforming stocks or periods is less likely to have its return replicated out of sample than one whose return is relatively unaffected by such stocks or periods. I'll give you a practical example that happened to me recently. I was looking at the returns of a strategy that has been running in real time for the last 3 years, and the highest stocks, the highest ranked stocks were supposed to do the best, and the lowest ranked stocks were supposed to do the worst. And I found that the reverse was the case. But that is because we had this a few months, about 6-month period when the lowest ranked stocks just did extremely well, and the highest ranked stocks didn't do quite as well. And the overall returns during that 6-month period were huge for every class of stocks, highest ranked and lowest ranked. So that particular period overwhelmed all the rest because I was using the compound annual growth rate. Now, I checked, and if I had been using medians or other robust measures like trimmed alpha, that outperformance of the low-ranked stocks would not have actually been apparent. I have a question on chat. What is meaningful average? Well, there are things like market cap, where it's hard to get a meaningful average because it's a kind of geometric range. You have a mass of companies that have market caps between 0 and 100 million, and then you have a few companies that have market caps in the tens of billions and now even trillion. So averaging those kinds of things is not very meaningful. So outliers, the law of outliers really applies to things where averages, where you would sensibly talk about an average, where there's not a logarithmic scale between the lowest and the highest. And of course, returns are the prime example. And taking care of outliers when computing regressions and returns is extremely important in backtesting. Alpha and beta. I have come up with a mathematical proof that I published that alpha and beta are inversely correlated so long as the market return tends to be positive. In other words, low beta portfolios are likely to outperform high beta portfolios. This applies only when you calculate alpha and beta by using a benchmark that constitutes the average returns of the securities among which you're choosing from. And it only applies when that benchmark's returns are more often positive than negative. If you're looking at the Japanese stock market, you're probably not going to find this. This is a mathematical law that applies to all asset classes. It's not just about stocks. It just has to do with the way average returns relate to individual returns. The inverse correlation, which I'm talking about here, is not terribly strong. It's like, if you would rank it on a scale of 0 to 100, it'd be about 52, 53. So it's not an extremely, it's not a factor that's going to make you a ton of money, but it's just, I just wanted to say that there are things about returns that you can look at mathematically and find mathematical relationships that really depend on how we're constructing portfolio measurements. And Chris is asking, is the outperformance of low beta absolute returns or relative returns or both? Well, it's really relative returns. It's alpha. And I probably shouldn't have said that low beta portfolios are likely to outperform high beta portfolios. I'm saying that low beta portfolios are likely to have higher alpha than high beta portfolios. Absolute returns is a different question. Now, here are some theories. These are not laws, they're theories. I use them all the time. Low price stocks tend to outperform high price stocks. The prices of small stocks have greater volatility than those of large stocks. Companies that have growing sales and shrinking inventory outperform companies that have shrinking sales and growing inventory. Companies that pay dividends regularly will continue to pay dividends regularly, and so on. There's thousands of others. They're all ready for you guys to test. Now, the correlation between past and future results, which is going to be the subject of about half of this webinar, is a very important idea. In order to figure out how to backtest, you have to find out the answer to the following question. Under what conditions do past, which we're going to be calling in-sample, results best correlate with future, which we'll call out-of-sample results? How many years should be backtested? How large a portfolio should be backtested? What performance measures should I use? Should backtested results be adjusted for outliers? How will optimization affect this correlation? The best way to backtest is the way that maximizes the correlation between past and future results. Now, to answer these questions, the best way to do it is to run a correlation study. You create strategies, you run equity curves, and you measure correlations. And running a correlation study is a lot of work. I mean, it takes you weeks. I've already done a number of them, and I'll share my results very shortly. But first, I want to tell you how I did it and how you can do it in case you want to do it yourself, in case you don't trust my results. The following correlation study is one I created myself, but I think you could create entirely different ones if you think you can improve on what I've done. Step one is to create between 50 and 100 different portfolio strategies. Now, ideally, these should not be back-tested strategies. These should be completely unback-tested. Get them from somewhere else. It's especially important that they not be optimized over any particular time period. They should not be developed by other Portfolio 123 users or by Portfolio 123 itself. For example, what I did is I created 50 strategies based on AAII stock screens. The strategies should not be random either. That should make some sense. They should be strategies that someone might actually use. If you don't follow these guidelines, what you'll end up with is very high correlation between past and future results. And that's not really very realistic. You want to try and make this study as realistic as possible. So that's why I use the AAI stock screens, because they have absolutely nothing to do with P123. And the strategies should be flexible enough so that you can increase or decrease the size of the portfolio. Step two is to run these strategies over as long a time period as possible and then rerun them with different portfolio sizes. That is a lot of work, but it's not that much work compared to creating the strategies themselves. Step three, in developing your own strategies, how long do you want your strategies to last? Do you anticipate changing your strategy every 6 months, every 3 years, every 10 years? Take your answer to that question, and that should be your out-of-sample period. Then measure the correlation between the total return of the out-of-sample period for your 50 or 100 strategies and the return of the immediately preceding in-sample periods. And those can be 1 year, 2 year, and so on, up to 12 or 15 years. It really depends on how long a period you can test and how many samples you want to do. And you can do this over and over again as much as your total time period allows. For example, If you're backtesting over the years 1999 to 2021, which is 22 years, with an out-of-sample period of 3 years, you could measure the correlation between 1999 to 2011 and 2011 to 2014. The first period would be the in-sample period, and the second would be the 3-year out-of-sample period. And then you could shorten the in-sample period to 11 years and do it again and so on, and go on to measure the correlations between the next 12-year and 3-year period, 2000 to 2012 and 2012 to 2015, and so on. You would get a mass of data, and you'd be able to look at all these different correlations. And what you're looking for is a good correlation of strategy ranks. In other words, ideally, you'd like to see strategy number 7 get good returns in the in-sample period and also in the out-of-sample period, and strategy number 17 get bad returns in both periods. I have a question. What time period have you found most effective for microcaps? I will be getting to that in a little bit. And considering all that massive data, what is the length of the in-sample period that best correlates with the out-of-sample period? My own personal results have been that 10 years is the most correlative in-sample period with a 3-year out-of-sample period. Now, I did not test microcaps specifically. I tested all sorts of different strategies. Some were invested in microcaps, some were invested in large caps, some were invested in value stocks, some in growth stocks, some combined, some used a lot of momentum, some were long-term holdings, tested all these different strategies. And I found that if you take a 10-year look back period, it correlates with the 3-year forward period best. 11 years and 12 years are also pretty good. But the fewer years you use, the worse the correlation is. With a 5-year in-sample period, I often see a negative correlation with my out-of-sample period, no matter how long the out-of-sample period is. So you want to be careful of using 5-year periods. Jim O'Shaughnessy gives a great example of this 5-year period in which companies with super strong sales growth outperformed all the others, and this kind of thing was never repeated. So I would really suggest you concentrate on 10 years and maybe 9, 8, 11, 12, 13, those kinds of periods when you backtest. Maybe 20-year would do really well too, but that was impossible for me to test as efficiently as it was the shorter periods. Also, the other problem with 20-year periods is that if you include the period from 2001 to 2006, you'll find that all factors worked great, just great. And that can be a little misleading. Now, step 4, now that you've determined the ideal in-sample period, you look at the results for varying the number of positions in your in-sample period. If you double, triple, quadruple, or quintuple the number of positions in your in-sample period, does the correlation of the strategy ranks without the out-of-sample period improve? In my experience, about 2 to 5 times the number of positions gives me better results than using the same number of positions. It's not a huge difference, but it is significant. Step 5 is look at which of Portfolio 123's backtesting tools gives you the highest correlation with the actual out-of-sample period. So is it the simulation, the rolling backtest, the screen, the rank performance test? Personally, I found that the simulation does the best, but it's not a huge difference. Rank performance is I don't know. These are all things that you should look at ideally, but I found the simulation is the most reliable. And step 6, which performance measure correlates best? Is it the CAGR, alpha, Sharpe ratio, and so on? I mean, if like me, you're interested only in getting the highest total return in the out-of-sample period, should you follow the strategy with the highest in-sample total return, or is it better to use a measurement like alpha or Sharpe ratio, or the gain to pain ratio is one that I found useful? Or do you get higher correlations if you trim or Winsorize your in-sample returns first? Now, if on the other hand, you're interested only in an out-of-sample strategy with a high Sharpe ratio, maybe your correlation, a different way of measuring portfolio returns might be optimal. I have found very little persistence with the Sharpe ratio, but I may be wrong. The information ratio, the other four measures, I found higher persistence. Those are all things to take into account. Again, my personal preference. This is kind of I don't find the difference between performance measures terribly great, but my personal preference is to use alpha, but trimming outliers and using a weekly or biweekly, a 2-week alpha period for alpha measuring. So these are the results of my correlation study, and these may differ significantly from yours. And to sum up, in sample period, 10 years, holdings 2 to 5 times the number of stocks held in the out of sample period, backtesting method simulation, and performance measure alpha using data whose outliers have been trimmed. Now we'll get to optimization. There are 3 things you'll want to optimize. Your universe, so what stocks you're choosing from, including liquidity minimums, excluded industries, rules to exclude certain stocks, portfolio management, which is the number of stocks to invest in, the optimal holding period, formula weights, and anything else involved in portfolio management, and ranking system, where you want to optimize individual factors in a ranking system. You want to optimize which factors to include and which factors to exclude, and you want to optimize factor weights. Now, optimizing has a bad rep. A lot of people say that if you run fewer tests and you do less optimizing, you'll get a better result because of mean reversion and imperfect correlation and so on. Well, my philosophy is based on probability. And if you have if you're backtesting 2 different strategies, and there is a positive correlation, even if it's minor, even if it's low, between the in sample and the out of sample, then the one that performs the better, according to your, whatever you've decided is your performance measure, is more likely to work than the one that performs worse. And that logically leads to optimizing and finding something that will work the best. But you always have to not over-optimize. And as I go through the optimization procedure, you'll see how I try to avoid over-optimizing and trying to make things that will work out of sample. Optimizing a universe. Now, liquidity limits are not to be optimized. This is I think when you're talking about the liquidity limits in your universe, you really have to rely on your firsthand experience of trading stocks. So here's what I do, and I calculate my expected excess return per position. If my expected excess return per position, excess in excess of whatever benchmark you choose, is 0, then there's no point in even investing. So you want to have some kind of excess return per position in thinking about investing. And I do this by looking at my transaction records. I sort by ticker, and then I subtract the return of a suitable benchmark for each period. And I've come up with my own expected excess return is about 5% per stock. Obviously, if I had a much longer holding period, it might be higher. If I were to trade much more frequently, then it would be lower. But that's about what I've calculated. Then I came up with a reasonable formula for slippage based on liquidity measures like the amount invested divided by the daily dollar volume and the median bid-ask spread divided by the price, and came up with a formula to calculate the slippage on each stock. And what I did is I excluded any stocks whose liquidity was so low that the slippage would be greater than half of the expected excess return. That's just one approach. That's kind of a complicated one. But I think you do need to place liquidity limits, and those should not be done based on back testing, because stocks with low liquidity, most ranking systems will make them outperform. So you want to avoid back testing when setting liquidity limits. Now, other rules, however, you can do using back testing. You can add hard limits. For example, you can run a variety of back tests with different ranking systems, different back testing methods, and different portfolio sizes to see whether adding a hard limit based on, say, Benish score or accruals or the Altman Z-score or any other measure add to or detract from your returns. I would not just apply this based on one back test. I would definitely do a variety of them before deciding. You also might want to exclude certain industries or categories of stocks and do this, and you can do the same, run some back tests. But also you should consider whether the measures you're using in your ranking systems really apply to the industries that you're including in your universe. So do banks, insurance companies, real estate companies, aerospace and defense companies, utilities, MLPs, ADRs, OTC stocks, biotechs, are all of those, do your factors actually apply to all those stocks very well? And if you think that they don't, then you can exclude them. Now, make sure to keep in mind that excluding certain industries only because they displayed poor returns in the past is a very, very bad idea because of the law of mean reversion. Now, optimizing portfolio parameters. In my opinion, the best way to optimize a portfolio is to use a ranking system you created 3 to 5 years ago or even longer, and then see what portfolio configuration works best with it during the period after you created it. If that's not possible, take a recently created and optimized ranking system and see what configuration works best with it during a period prior to your backtesting. At any rate, what you want to avoid is backtesting for portfolio optimization using a ranking system that was backtested during the period you're backtesting for portfolio optimization. Why? Because during an out-of-sample period, a ranking system will often perform far better if it chooses more stocks rather than simply the ones that rank at the very top. During an in-sample period, it'll almost always perform best by choosing the very top stocks. So I have found using old ranking systems that a strategy that chooses just the top 5 stocks is not going to do very well, whereas a strategy that chooses the top 15 or 20 will do much better. But if I were to perform that same test using in the same period in which I'm backtesting, if I were to perform it using the ranking system that I currently use, I would not find that. I would find that the very top stocks would perform the best. And that's just a kind of obvious consequence of optimizing ranking systems. So I think it's very important to treat your portfolio parameters and your ranking systems separately, and to optimize them totally as separately as you can. Because if you do them together, you're going to end up with portfolio practices that are not suited to out-of-sample ranking. And the things that you might want to vary in your backtesting include the number of stocks you hold, your buy rules and your sell rules, formula weights, the minimum holding period for your stocks, the sector, subsector, or industry counts in your portfolio, the maximum weight of a single position. I'm sure you can think of other things. These are all portfolio management tools that you want to test and backtest, but preferably not on a ranking system that you've optimized during the period of testing. Now, optimizing factors. Now, certain factors can benefit from optimization instead of simply higher or lower is better. Size factors, not too tiny, not too big. A lot of people, and I was like this for many, many years, just basically said size lower is better. And because there's more responsiveness at the lower end. But I've found recently that if you get really low down on the liquidity and market cap and level, you find stocks that are just behave totally crazy. And you get some stocks that really aren't as responsive as stocks that have a slightly higher market cap or a slightly higher average daily dollar volume. So that's why I take my size factors and I try to optimize them a little. You may not need to. I mean, you may just be happy with lower is better. Or if you may not use these size factors at all. Sector, subsector, and industry preferences. You can create a factor that favors certain industries and ranks others low. And I talked about that in a previous webinar a little bit, but it's basically using the eval command and the Arbix codes to give certain higher weights to certain industries and sectors and subsectors than others. And growth factors. Some growth factors might benefit from ranking companies with middling values highest. And I did go over this in a previous webinar. I'm not going to repeat that, the process of how to create those factors, but I do want to talk about how to optimize these factors, how to actually test them. So for me, the best way to do this is to take your universe and split it into compartments and test your ranking system that excludes those factors on each of those compartments. So you take the ranking system that you're currently using and you put 0 weight on the factors that you're testing. And then you put in your universe rule just a small part of your universe. So for example, you could use between F rank, market cap, ascending previous, exclude NA, 90-100. That will limit your universe to the very tiniest stocks. And so then you eliminate the size factors from your ranking system, like I just said, and you test it on this universe. And then you repeat the test after changing 90-100 to 80-90, and you do it again, changing to 70-80, and so on. And you can see what your optimal market cap range might be by looking at the performance results. And then you can write your size factor accordingly. And you can do the same thing with industries, subsectors, or sectors, or with growth rates. Now, when you're doing it with industries, subsectors, or sectors, you do not want to say the industries, let's just say subsectors, because that's what I use. So you do not want to say the subsectors that have performed the best in the past are the ones that are going to, with my ranking system, are going to be the ones that I rank the highest, because there's maybe some sectors that perform terribly overall or very well overall, and you don't want those to get a higher rank. So you want to compare the overall return of the subsector with the return of the subsector in your ranking system. So for that kind of test, it's very important not to just take the returns at face value, but you have to run regressions or use alpha based on the particular subsector you're using, or you can look at the high and the low and in the ranking system. And for example, one way to do this might be to say, okay, which subsector has the greatest difference in returns between the top 10% and the bottom 10%, or the top 20% and the bottom 20%? I'm going to give those subsectors a slightly higher weight. And subsectors that show very little difference between the top 20% and the bottom 20% will get a lower weight. So you just want to be careful not to overweight subsectors just because they outperformed in the past, regardless of your ranking system. You want to test the responsiveness they have to your ranking system. Now, optimizing a ranking system. You can combine two questions: which factors to use and which to exclude, and what weights you should you assign your factors into one test by allowing 0% weights for your factors. One way to do this is to develop a long list of factors and have most of them get 0% weights, but have a few of them get higher weights. And set up a number of different universes that are subsets of your universe. So I use the command mod stock ID, 5 equals 0, mod stock ID 5 equals 1, and so on to set up 5 different universes. You could also divide your universe according to sectors, subsectors, industries, or sub-industries. There may be other ways to divide your universe. You maybe could want to divide your universe according to size of this, market caps. But this is a very useful way of making sure that you're not over optimizing your ranking system and not having it be subject to certain particular stocks. This way, you're testing on a universe just 1/5 of the size, or whatever, 1/3, 1/10, however many times you want to do it. And you'll see if your results are really bad in some in some sections of your universe and really good in others, then you know that you have a rather imperfect ranking system. This is called bootstrapping. Bootstrapping is a machine learning technique that is very widely used. I'm using it in a non-machine learning manner because I'm not a machine, but it kind of comes close to a machine learning manner. And I got the idea from James O'Shaughnessy, who writes about it in the 4th edition of What Works on Wall Street. Vary your portfolio weights iteratively until you get the ranking systems that perform best in each subset universe, as well as ranking systems that perform well in all of them, and then average the weights of those outperforming ranking systems. That's how I optimize ranking systems. It's a lot of testing, but it's kind of fun. A few tips and warnings about this. Don't vary factor weights by less than 2%. It's a complete waste of time. One way to do this is to have all factor weights divisible by 4% or 2.5% or 2%, and then randomize. I think 4% is a pretty good way to do it. There's a little less testing than if you do 2%, but you could. I kind of do all three. The amount of backtesting this method involves is extreme. Expect to spend a lot of time on it because you're testing all these different iterations of ranking systems on 5 different universes. So, if you have 30 different iterations, 30 different variations of a ranking system, that's, 150 backtests. It's time consuming. So just expect to spend a lot of time on it, or you can automate your backtesting using the API or the data mine. I've got a question. When splitting universes into 5 pieces, do you do most testing on the first 4 and a final test on the 5th to get an out of sample result? I do not. And maybe I should. A lot of people do that kind of thing, but I haven't. Now, keep in mind, you don't have to be perfect or ultimate in your optimization. A very rough approximation is good enough. You'll find that the highest ranked stocks are pretty much the same after a certain point. Now, here are some common backtesting mistakes. Optimizing only on the entire universe you'll be choosing stocks from. Like I said, bootstrapping is pretty important. If you optimize on the entire universe that you're choosing stocks from, 1 or 2 tickers may make a huge difference, and you might not get as good out of sample results. Optimizing on a short time period, like I said, 5 years is not a good time period to optimize on. Optimizing using the small number of positions. Like I said, again, I would optimize on using 2 to 5 times the number of positions that you actually expect to hold. When you're bootstrapping, you can just use a small number of positions because you're optimizing on 5 different universes. So essentially, you're optimizing on 5 times the number of positions. Believing that an optimized result is achievable out of sample. If you get, after you optimize, you often end up with totally unrealistic returns. You have to keep in mind that these are unrealistic returns. You're never going to get as good returns out of sample as you do when you optimize. If you've been optimizing strategies for the last few years, then you can look at how those old strategies did, and that will give you more, it did in the out of sample period, and that'll give you more of a realistic assessment of what your potential is. Another error, basing your optimized portfolio parameters on testing a period with a ranking system already optimized over that time period. And I talked about this a little bit. Basing your preferences simply on CAGR rather than trying out more robust performance measures. Taking into account only overall performance rather than looking at performance during various discrete time periods is another backtesting mistake. Now, many portfolio performance measures will take care of this for you. Doing a trimmed 2-week alpha will, basically exclude. It will basically look at overall performance over a lot of discrete time periods. But what James O'Shaughnessy does is he divides his time periods into discrete periods and never backtests on the entire thing. Just like I don't backtest on my entire universe, he doesn't backtest on his entire time period, and he averages the results from discrete time periods. So, there are various ways to deal with that. There is also a backtesting mantra that says you should always leave an out of sample period at the end of your testing period that you can then see if it worked over that out of sample period. The problem with that is there are 2 problems with that. Number one, I want to take into account the changes that have happened in the stock market in the last 3 years. I don't want to leave them out. And number 2, that tiny little out of sample result may not be very indicative of anything. I mean, my strategy just didn't work in 2019. It was just a terrible year for this kind of strategies I'm using because small caps did terribly during that year. If I had been holding out 2019 as my out of sample period, I would never have been able to optimize anything. So there are problems with that. So that's why I don't do that. But I mean, most backtesting books are going to tell you you should always leave an out of sample period at the end of your in sample period to run your system on. Well, to each his own. Lastly, stress testing your systems. It's vital to subject your systems to stress tests. And Ricardo, my colleague, Ricardo Tambara, has given a webinar on this. And I suggest you watch that. I've also written a blog article on it called Break Your Strategy. And there are links in the slides. When you get them, you'll be getting these slides very shortly. And you can link to those. I think that backtesting for failure may be almost as important as backtesting for success. So it's important to subject your strategy to these kinds of tests. And that's it. Now, are there any further questions, or is anyone confused by something, or did I fail to cover something that you were expecting me to cover? Please use the chat box to tell me. Okay, I had a question. Exactly how do you use the 5 universes? Well, I perform the same iterative backtests on all 5 universes. I get the results, and then the ranking strategies that perform the best on those on each of the 5 universes go into my I average those best performing strategies to get my final strategy. So that's how I use them. And I get quite different results from these 5 universes. They just have different stocks. So it's helpful to try and see what works best for them. So I'm going to have another webinar on strategy implementation on July 28th, 2 weeks from today. And we will finish the webinar now.